Lockheed Martin stock is currently trading at $512.53, marking a sharp intraday decline of 3.26% as of this Monday morning, April 27, 2026. While the broader market is looking for a sense of direction, Lockheed is feeling the weight of a 9-session losing streak that has fundamentally shaken investor confidence in the defense giant. You might look at the headlines and see the standard narrative about defense budgets or global tensions, but there is a much deeper story playing out in the order books that most people are completely missing. The expectation here was a solid start to the year backed by a record backlog, but the reality hitting the tape right now is a book-to-bill ratio of just 0.6. That means for every dollar of revenue Lockheed is booking, they are only bringing in 60 cents of new orders. That is a massive red flag for a company that is supposed to be the bedrock of a long-term defense strategy, and it suggests that the massive supercycle everyone was betting on might be cooling off, or at the very least, facing serious bureaucratic bottlenecks. When you look at Lockheed Martin stock through the lens of a smart investor, the common ground we all share is the belief that this is a safe play because of the sheer scale of the F-35 program and the missile defense contracts, but the reality is far more volatile right now. We are seeing institutional activity shift away from the buy-and-hold defense mentality as the company struggles with a negative free cash flow of $291 million this past quarter. That is not something you see every day from a $100 billion titan. The culprit isn't just the economy, it is a complex mess of internal ERP system migrations and performance issues in the aeronautics segment that have delayed deliveries of the F-16 and C-130 programs. While many retail traders are focused on the geopolitical drama in the news, the smart money is watching these internal operational failures. This creates a curiosity loop. If the demand for weapons is at an all-time high, why is Lockheed's stock falling like a stone? It is because the market is realizing that having a massive backlog doesn't matter if you cannot convert those orders into cash efficiently. Recent movement on the charts shows the stock dipping as low as $503.60 during this session, with trading volumes spiking nearly 73% above the daily average. This is a clear sign of institutional distribution. Big funds are reevaluating their positions, and we are seeing a rotation away from the aerospace and into more nimble sectors. Even with a 2.7% dividend yield, the price action is telling us that the yield trap fear is real. Compare this to something like Nvidia stock or even Tesla stock, where the volatility is expected. With Lockheed, the market expects stability, and when it doesn't get it, the reaction is violent. If you were using a platform like Interactive Brokers or the Robinhood app to trade this, you've likely seen the alerts hitting your phone all morning. The sentiment is currently oversold on the Relative Strength Index, which usually invites a bounce, but the fundamental pressure from the earnings miss, $6.44 per share versus the $6.74 expected, is keeping the bulls at bay. Comment below how many shares of Lockheed Martin stock you currently hold, or if you are waiting for it to hit the 500 support level before buying in. To understand why this is happening, we have to look at the business model. Lockheed Martin is essentially 4 companies in one: aeronautics, missiles and fire control, rotary and mission systems, and space. Aeronautics is the crown jewel, home to the F-35 Lightning II, which is the most expensive weapons program in history. When that segment suffers from lower net profit booking rate adjustments, as we saw this quarter, the entire ship starts to tilt. Their space segment actually saw a 7% jump in sales recently, driven by the next-generation interceptor, but profit there fell by 26% because they didn't have the favorable program completions that boosted the previous year's numbers. It is a business of milestones, and when you miss those milestones, the stock pays the price. Past performance in 2025 showed a record backlog of $194 billion, which led many to believe 2026 would be a breeze. Instead, we are seeing the reality of government contracting, delays, supply chain friction, and the high cost of innovating in an environment where the Department of War is shifting its acquisition strategies. For those of you looking at online investing or self-investing options, whether through Fidelity Investments or SoFi Invest, the question is whether this dip is a gift or a warning. Lockheed is trying to pivot. They are investing heavily, billions of dollars, to triple their PAC-3 missile output and quadruple their THAAD production. They know the future is in munitions and high-speed missile defense, not just fighter jets. But that transition takes time and immense capital. Management is still sticking to their full-year guidance of $29.35 to $20.25 in earnings per share, which implies they expect a massive recovery in the second half of the year. They're betting on the fact that the cash flow issues caused by their new software system will be resolved by the next quarter. If they're right, the current price in the 512 range is a bargain. If they're wrong and those supply chain issues in the C-130 and F-16 lines persist, we could see the stock break through that $500 psychological floor. The institutional side is showing a split. While Bank of America and Morgan Stanley have slashed their price targets, they still keep them well above current levels, ranging from $600 to $653. This suggests that the experts think the market is overreacting to a temporary cash flow hiccup. However, the 0.6 book-to-bill ratio cannot be ignored. It suggests a digestion period where the Pentagon and allied nations are waiting to see results before cutting more massive checks. If you were using an intelligent portfolio or an online investing tool like Schwab Intelligent Portfolios, you might notice defense weightings being adjusted to account for this higher than normal volatility. Unlike the rapid growth seen in Nvidia stock, Lockheed is a slow-moving giant that requires patience. The tension between the expectation of a defense supercycle and the reality of a negative cash flow quarter is what is driving this 3% slide today. If you are navigating this market through a Fidelity brokerage account or using the Robinhood trading platform, you have to decide if you believe management's story. They are calling this a transition year for their operations. They are spending $511 million on capital expenditures and $458 million on research and development just this quarter. That is a lot of future-proofing that isn't helping the bottom line today. But in the world of aerospace, today's spending is the revenue of 2028 and 2030. The risks are clear. Inflation is eating into fixed-price contracts, and the geopolitical landscape is so volatile that a shift in government policy could alter the backlog overnight. Yet the opportunity lies in the fact that Lockheed is still the primary partner for the US and its allies. They are literally too big to fail in the eyes of national security, which provides a floor for the stock that many other sectors simply don't have. When you look at your portfolio on the Fidelity mobile app or through your Interactive Brokers account, consider the long-term catalysts. The expansion of munitions production is a direct response to the global need for active deterrence. This isn't just about making planes anymore. It's about the software, the integrated air defense systems, and the satellite constellations that Lockheed is building. The reality of the current stock price is a reflection of short-term operational pain, but the expectation for the end of the year remains quite high. If Lockheed can prove in Q2 that their cash flow has returned to positive territory, this 9-day losing streak will look like a blip on a long-term chart. But for now, the market isn't show-me mode. It doesn't want to hear about a $194 billion backlog. It wants to see the cash from those orders hitting the bank. In summary, Lockheed Martin is currently a battleground between the narrative of defense necessity and the reality of operational inefficiency. We started the day with the stock at $512.53, reeling from an earnings miss and a negative cash flow report that few saw coming. While the backlog remains impressive, the book-to-bill ratio and the internal software transitions have created a period of extreme vulnerability. We've seen a massive gap between what the market expected, a smooth continuation of the 2025 growth, and the messy reality of the 2026 first quarter. This analysis shows that while the long-term thesis for a defense giant remains intact, the short-term path is fraught with supply chain hurdles and margin pressure. Whether you are using SoFi Active Investing or a traditional Fidelity wealth management approach, the key is to watch that $500 level. If it holds, the recovery could be swift. If it breaks, we are looking at a much longer winter for the aerospace sector. The authority of Lockheed Martin as a market leader hasn't vanished, but it is certainly being tested by a market that no longer rewards promises without performance. Stay grounded, watch the volume, and remember that in the defense world, the biggest moves often happen behind the scenes long before they hit the ticker. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.